It's really not that surprising that Jim Cramer didn't beat the market, because think about his show. He is picking hundreds and hundreds of stocks in each year, so it's not surprising that his performance over a long period of time with such a large number of stock picks is going to kind of reflect the market average. So another way of looking at is the market efficient is to compare how professional investment advisors do against randomly picked stocks and as well as against the market as a whole. This is a peer-reviewed academic study that I did a number of years ago examining market efficiency. In the 1980s, a book came out by Robert Mackill, an economist, who proposed that the market is so efficient that investors could do just as well as by throwing darts at the Wall Street Journal stock listings as to rely on professional investment advisors. That was controversial at the time because professional investment advisors charge for their services, and they didn't really like the idea of an academic proposing that they didn't really add too much in the way of value. So the Wall Street Journal decided to have a contest whereby every 6 months they would invite 4 professional investment advisors to make stock picks, and during that same 6-month period they would randomly pick 4 stocks, and over each 6-month period they'd compare the returns of the professional investment advisor picks to the returns of the dartboard picks. That is, the randomly picked stocks. And then we added in this paper the market as a whole, the S&P 500 as well as the Dow Jones Industrial Average, to show the entire market. We did the really fun thing in this article of going back to all the old Wall Street Journal articles and reading them and recording in each 6-month time period what stocks the professional investment advisors chose, as well as the dartboard picks by the Wall Street Journal. So these are the randomly picked stocks, and as you can see, we had to read quite a few articles of the Wall Street Journal to collect this data. And then we tabulated it, and the professional picks over this period from 1990 to 2001, so the contest began in May 1990 and ended in May 2001. By the way, it ended in May 2001. Guess why? Well, the pro picks during this period of time, their average annual return was 7%, and the dart picks, the randomly selected stocks, the return on them was 9%. So the randomly picked stocks outperformed the professional investment advisor picks. You can see why the contest ended. Professional investment advisors had no interest in reading this article anymore. Plus, I think at this point, the evidence was pretty clear that it's really tough to beat the market. So one of the implications is that instead of paying for an actively managed mutual fund, you might want to just invest in an index mutual fund. But we wanted to look a little bit more deeper, so we ask ourselves, how did the market do as a whole during this time period? So we look at the S&P 500, and we see that the average annual return for the S&P 500 over this period of time was 14%, quite a bit higher. And then we kind of looked hypothetically at how if an investor at the beginning of this contest, if they had invested $10,000 in either the professional picks portfolios, in the randomly picked dartboard picks, or the S&P 500 or the Dow Jones Industrial Average, and we could see that if you had invested $10,000 at the beginning of the contest and either the pro picks or the dart picks, you would have ended up with somewhere around $15,000 in your portfolio. But had you invested in the S&P 500 during this period of time, you would have close to $40,000. So based on this evidence, the market's pretty efficient. The professional investment advisors, they had some reputational risk because everyone could see how well their stock pick did. They could not beat the market. And these are professional stock pickers at large companies, mutual fund managers, and so forth, financial analysts, who's their job to try to find good stocks. From time to time, there will be an investment strategy that appears to refute the efficient market hypothesis. In other words, there appears to be some type of investment strategy that would enable investors to beat the market. Recently, one of those investment strategies has been buying high dividend paying stocks. And for a period of time, high dividend paying stocks beat the market, and not surprisingly, mutual funds that catered to investors' preferences for high dividend stocks, those mutual funds did quite well. And we can see here over this period of time in this article, and by the way, this article and all articles are located on Blackboard, so you can read them in depth outside of the video. And we can see that the S&P 500 right here, and we can see the portfolio of high dividend paying stocks that are listed right here, that it really looked like it beat the market, at least during this period of time in 2016. And I'm like, well, okay, you might say, well, this is evidence that the markets aren't very efficient, because if you can simply just buy stocks that are paying dividend and beat the market, that implies that the dividends aren't fully priced into the market and the market's not efficient. And I would just say, well, let's hold on just a little bit of time, because this is a relatively short period. Going to Morningstar, we could go to Yahoo Finance, anywhere else, we can compare the performance of high dividend paying stocks to the performance of the S&P 500. And if we do that, we can see that for the most part here, the orange line right here, this is the S&P 500. The green line are the returns on the high dividend paying stocks. And we can see the period of the article, yes, it appears that high dividend paying stocks are beating the market as a whole. But if you look pretty much across the board, the S&P 500 is outperforming, or at least is performing as well as the high dividend paying stocks. So over the long run, or at least consistently, it does not appear that a strategy of investing in high dividend paying stocks beats the market. So that's some more evidence that markets are efficient. Now, that's not to say that markets are perfectly efficient all the time. And that is because investors are not rational all the time. There are behavioral biases inherent in all human beings that can temporarily drive market prices away from their true fundamental values.